The recession kicked in about 18 months back. Not the flashy version they will highlight on evening news. Not the textbook case where an economist stands up and declares 2 straight quarters of shrinking GDP, meaning we have officially entered recession territory. What I am talking about is the quiet one already unfolding beneath your feet right now. You can see it clearly in everyday numbers like consumer credit card balances climbing past $1.21 trillion through 2025, small business closures jumping 31% compared to the previous year, and the 10-year Treasury yield early in 2026 holding firmer than during the height of the toughest inflation spike the country faced in 40 years. This is no mere red flag waving in the distance. The entire system is burning and no one seems willing to sound the alert. What sets this apart from all those typical recession warning talks you have heard before is something deeper. We are not discussing just another routine economic dip in the business cycle. Instead, we are witnessing the early clear signs of a fundamental shift in the global monetary order. A real transformation in how money itself operates and what backs it. Your retirement accounts and 401k plans were built around the old set of assumptions that appear to be fading away for good in the current environment. Over the coming minutes, I will break down exactly how this process unfolds step by step. I will cover the repeating historical patterns that keep showing up across centuries, the 5 powerful pressures coming together all at once, something that has not happened in the last 80 years. And the 3 practical moves I am making right now with hundreds of thousands of my own dollars allocated across broad stock indexes, real estate holdings, and a portion in gold. I am not suggesting you mirror my choices exactly. My goal is simply to lay out the logic behind them so clearly that you can adapt the thinking to fit your own life and goals. Incidentally, I created a straightforward free retirement planning tool because so many popular online versions contain basic math flaws. It draws on the same modeling approaches used by major firms like BlackRock and Vanguard to highlight hidden vulnerabilities in typical plans. I only request your email address to deliver the personalized report, and I make sure none of your private financial details get stored. You will find the link down in the description area. Let me share a useful analogy with you now. This comparison is one we will revisit often because it explains the situation far better than any graph or table ever could. Picture the worldwide financial arrangement as one giant long-term commercial rental agreement. Following the end of World War II, nations around the globe entered into this deal with the United States. The conditions were pretty direct and easy to grasp. The American dollar would function as the primary reserve currency globally. Every nation would keep substantial dollar holdings in reserve and conduct major international transactions, especially oil sales, using dollars. In return, the United States committed to keeping the currency reasonably stable, controlling inflation within limits, and using its military strength to protect key shipping lanes and trade paths. This arrangement has lasted roughly 80 years. For the majority of that period, it delivered real benefits to everyone involved. Other countries gained reliable access to a widely trusted form of money for global dealings. The United States in turn enjoyed a unique advantage: the power to issue the currency the rest of the world needed. This allowed America to sustain large budget shortfalls that would cripple any other country while still attracting eager buyers for its government bonds. Both parties gained from the setup. Yet every extended rental contract eventually runs into trouble. The property owner begins bending the rules in its favor, and the renters start exploring other options quietly. The initial major shift came in 1971 when President Nixon ended the direct convertibility of dollars into gold. Up until then, foreign governments holding dollars could in theory redeem them for a fixed amount of gold. After that point, the link was severed. The dollar now rested solely on confidence in the United States government and its promise to honor its obligations. Confidence is ultimately a mental and emotional factor. Such psychological foundations do not weaken in a steady, predictable line. They remain steady for long stretches. They stay firm. They stay firm. They stay firm. Then suddenly they do not. We have entered that sudden shift phase. I will lay out the concrete figures illustrating this change shortly. Before that, though, let me highlight a critical detail about the makeup of American government borrowing that ties all the pieces together. America now carries approximately $36 to $39 trillion in total national debt. That figure equals roughly 120 to 104% of the entire economy. Imagine earning $60,000 annually yet carrying $72,000 in credit card balances. Your personal debt burden would match the current position of the United States government. You may be thinking we have faced big debt loads in the past and come through fine. After World War II, for instance, debt reached 106% of GDP. And the country eventually grew out of it. That is correct. But the key difference I want you to grasp is this. Many people focus on the sheer size of the debt as the main issue. The size is not the core problem. The underlying composition and sustainability of that debt is what really matters. Back after World War II, the population was young and growing. Domestic factories dominated manufacturing. The nation was a net lender to the world, with others owing us rather than the reverse. Strong productivity gains stretched out for decades ahead, providing room to expand beyond the debt burden. Today the picture looks quite different. An aging society. Manufacturing largely moved overseas. He lay freit for froth. A net borrower status. And here is the uncomfortable statistic few leaders want to discuss openly. During 2025, interest costs on the national debt crossed the $1 trillion mark for the first time ever. Surpassing the full annual spending on national defense, America is now allocating more money simply to service past borrowing than to safeguard its frontiers. This situation goes beyond a standard debt challenge. It resembles the mechanics of a classic Ponzi arrangement. And such arrangements only resolve in two ways. Either fresh participants keep joining to sustain the flow, or the supply of new participants dries up and the structure unravels. For the past 15 years, the Federal Reserve has acted as the ultimate backstop buyer. Whenever bond yields surged sharply, whenever markets signaled reluctance to lend at prevailing rates, the Fed would create new money and purchase the bonds directly. Policymakers refer to this politely as quantitative easing. In plainer terms, it amounts to turning government debt directly into currency. The approach functions effectively until it stops working, because the side effect is higher inflation. Even following 2 full years of sharp interest rate increases, inflation remains stubbornly above the Federal Reserve target of 2%. The benchmark 10-year Treasury yield sits above 4.5%. Markets are insisting on greater returns to hold American government obligations because underlying concern is growing. That concern signals the long-standing agreement is starting to loosen. Soon I will outline the realistic end scenarios, including possibilities that blend digital assets like Bitcoin with international power dynamics. It may sound far-fetched at first until you follow the motivations and pressures step by step. But let us first examine why the key indicators that Ray Dalio has highlighted for several years are now lighting up brightly across multiple measures. This is the section where the discussion becomes especially compelling. Dalio leads Bridgewater Associates, the biggest hedge fund operation globally, managing well over $150 billion. He dedicated years to analyzing what he terms the long-term debt supercycle, reviewing the complete histories of past dominant reserve currencies such as the Dutch guilder, the British pound, and the Spanish real. He uncovered an almost predictable sequence that repeats with striking regularity. Every leading currency follows a similar path of ascent to supremacy, followed by overreach and eventual erosion. Each phase produces distinct observable markers. In 2022, he released the book The Changing World Order. I went through it twice, then a third time, marking key passages. His model outlines 5 interconnected dynamics that drive these major transitions. Domestic stability or turmoil, including gaps in wealth distribution and internal political cohesion within the leading nation. International stability or friction, covering alliances, rivalries, and conflicts. The broader debt accumulation pattern. Unexpected events from nature. And advances in technology. Under ordinary conditions, these elements move at varying speeds. One rises while another eases, creating some natural balance. At present, however, all five are intensifying at the same moment, a convergence unseen for 80 years. Begin with the internal side. In 2024, the wealthiest 1% of Americans controlled 32% of total national wealth, while the lower half held just 2%. That disparity exceeds the levels seen in 1929, just before the Great Depression struck. Consider what this imbalance means for your personal finances in practical terms. Not as some distant political debate, but as a direct mechanism affecting asset values and investor behavior. Extreme wealth concentration tends to fuel social and political tensions. Those tensions in turn make large institutional money managers hesitant to lock funds into long-dated American government securities. When doubt grows about whether commitments will be met decades ahead, investors avoid buying 20-year bonds offering only 4%. They turn instead toward gold and other tangible stores of value. They shift capital into holdings resistant to erosion through inflation or outright default. Evidence of this shift is visible today. Central banks worldwide acquired around 1,045 tons of gold during 2024, marking one of the strongest years since records began. Countries including China, Russia, India, and Turkey led the way. They are not accumulating gold for its appearance. They are methodically lowering reliance on assets tied to the dollar. This mirrors the cautious renter who tours alternative properties discreetly while continuing to pay current rent to avoid alarming the owner. The shift happens gradually and without fanfare, until it accelerates suddenly. If you are enjoying the discussion, please subscribe now. Otherwise, the platform algorithm might stop recommending my content to you. Next, consider the external pressures that have sped up the overall process. In 2022, the United States excluded Russia from the SWIFT international payment network as a response to the conflict in Ukraine. Analysts labeled it a powerful financial sanction with nuclear-level impact. It froze substantial Russian reserves held in dollars. The move achieved its immediate objective. Nuclear-style measures, however, come with a lasting cost. They can be deployed only once before others begin preparing defenses. Afterward, any nation that has clashed with American foreign policy starts constructing backup systems. A simple illustration captures this shift in power. Imagine a small island that handled all its commerce through one dominant shipping firm. That firm controlled the sole docking facility. The island accepted the rates, the terms, and the conditions without protest. What alternative existed? Then in one instance the firm withheld a cargo shipment amid a political dispute. The next year a rival operator constructed another dock on the opposite shore. Overnight the island gained real choice. And the original firm lost its ability to dictate prices. The SWIFT exclusion acted as that withheld shipment. Today the alternative infrastructure is rising visibly. Russia and China now conduct energy deals directly in yuan and rubles. China struck agreements with Brazil to exchange goods using their native currencies, bypassing dollar conversion. India purchases Russian energy paying in rupees. Even Gulf nations that helped establish the dollar-oil linkage decades ago now explore settling transactions through multiple currencies. This development is not confined to speculative online forums. It appears in official diplomatic communications and government finance discussions. Using the dollar as a geopolitical tool inevitably prompts others to create workarounds that reduce dependence on it. This outcome stems from straightforward incentives, not hidden plots. If one party can exclude you from essential global transaction systems over policy disagreements, you will naturally develop independent channels. Once those channels exist, other nations concerned about future exclusion begin adopting them. Not out of hostility toward the United States. Simply because viable alternatives now exist. The process resembles the dynamics of a bank run. A bank does not collapse solely because its balance sheet is weak. It collapses when enough depositors suspect weakness and withdraw funds, creating the very weakness they feared. A self-reinforcing cycle. Allow me to introduce you to someone like Marcus. He is not based on one individual but represents a common pattern I encounter frequently in discussions. Marcus is 44 years old. He has contributed the maximum to his 401k account since his late 20s. His holdings follow a typical balanced mix around 60% stocks and 40% bonds through a standard target date fund. He reviews the account value, quarterly notices the growth, and feels reassured. Marcus resembles the renter who automatically extends the lease for another term without carefully reviewing updated conditions. I will return to Marcus later because his experience over the coming decade captures the central message here. Now let us examine a concrete example with actual figures. This is where abstract ideas connect directly to your personal financial reality. Consider David. He is 42 years old. His 401k holds about $35,000 invested almost entirely in a target date fund aiming for 2047. He earns $11,000 annually. He contributes 6% of pay with an additional 3% match from his employer. David has tested his projections using various popular retirement tools. Most deliver similar forecasts. Retirement around age 65 with roughly $1.8 million accumulated. On the surface, his plan appears solid. Yet those tools rest on several key premises. Average yearly real investment returns near 7%. Average yearly inflation around 2.5%. And the often unspoken assumption that $1 today will retain comparable purchasing power to $1 in 2047. Disrupt any single one of those premises and the entire projection unravels. Intelligence infiltration ravels. Focus first on inflation. Suppose the government, confronting heavy debt and struggling to sell bonds to foreign investors, chooses to permit higher inflation as a way to lighten the real burden over time. This approach has been used repeatedly by indebted governments throughout history, from Britain after the World Wars to Argentina in recent decades. If inflation instead averages 5% yearly rather than 2.5% across the next 23 years, David would discover that his $1.8 million at retirement buys only what about $8,000 buys today. $1 million in real value would simply vanish. Yet the account statement would continue showing $1.8 million. The headline number stays unchanged. The actual buying power disappears. Now examine the second premise. Should the dollar gradually lose some of its dominant reserve position even modestly? The United States would need to offer higher yields to keep attracting bond buyers. Elevated rates push down existing bond values. They also compress stock market valuations. Every equity price ultimately reflects future cash flows discounted using prevailing interest rates. Higher discount rates shrink the current worth of tomorrow earnings. Current stock market levels assume America can continue borrowing at low cost indefinitely. If that foundation weakens, we face more than a modest market pullback. We confront a broad revaluation of nearly all dollar-based financial assets. David target date fund designed to shift automatically toward bonds near retirement would suffer significantly in such an environment. Longer-term bonds decline sharply when rates climb. This is basic mathematics, not speculation. Here is the troubling imbalance worth reflecting on. David followed every standard recommendation for 16 years. He saved steadily, avoided emotional selling during downturns, maintained a balanced allocation. Yet the outcome where he loses substantial purchasing power is not some rare catastrophe. It represents a plausible result of the monetary evolution already visible today. Those who suffer most during these transitions are rarely the high-risk speculators. They are often the diligent, consistent savers who placed full trust in established systems without ever questioning the underlying rules. This is not an accidental shortcoming. It is how the system is structured. It relies on individuals like David remaining steady and committed without deeper scrutiny. Let us pause briefly because the structural challenges can feel heavy. We all need a moment to reset. Envision yourself as the Federal Reserve Chair in 2028. You sit in an elegant wood-paneled office consulting with 3 senior advisors. The first warns that raising rates would tank equity markets and trigger lengthy congressional hearings. The second cautions that cutting rates would reignite inflation to 8%, sparking even longer hearings. The third notes that holding steady risks a rebellion in the bond markets, with Congress again assigning blame personally. Meanwhile, you sit in an expensive suit reflecting on the high-level consulting job offer you declined years earlier and wondering whether that door remains open. This is not exaggeration for effect. It accurately describes the difficult bind facing policymakers. Each available option carries consequences nearly as severe as the issue it aims to address. That is the reality when an unsustainable borrowing dynamic begins losing new participants. Stay engaged, because the following insight is frequently overlooked, yet it reshapes how we approach solutions. A fourth element in Dalio model that deserves attention is technological progress, particularly artificial intelligence. Here the picture grows nuanced and potentially hopeful. Artificial intelligence could serve as a significant counterforce capable of offsetting some inflationary pressures. Recent analysis from the International Monetary Fund suggested AI might impact up to 40% of jobs worldwide. If AI meaningfully lowers production and service costs, it might ease price increases. It could grant additional time for fiscal adjustments, possibly, yet the opposite effect also exists. Widespread job displacement from AI could reduce household incomes, tax revenues, and overall spending. Governments might respond with increased support programs, leading to larger deficits. That in turn requires more borrowing and issuance of securities, placing further strain on confidence in the currency. These dynamics do not move in straight lines. They reinforce each other, interact, offset, and amplify in complex ways. No simple single policy fix exists. The challenge is systemic. The situation takes an even more intriguing turn when considering possible American responses. I approach this cautiously because my focus remains on documented incentives rather than pure speculation. There exists a meaningful, though uncertain, chance that the United States might seek to restore tangible backing to the dollar. Two main pathways appear. On the traditional side, America is said to hold roughly 8,000 tons of gold reserves, primarily at Fort Knox. Independent verification of the full holdings has been limited since the 1950s. At recent prices near $3,000 per ounce, that gold is valued around $760 billion. A sizable sum until compared against $36 to $39 trillion in total obligations. Backing even a modest portion of debt would require dramatically higher gold valuations, perhaps exceeding $43,000 per ounce. Such a revaluation would itself represent enormous monetary upheaval. The alternative, involving Bitcoin, feels more contemporary. A few years ago, this idea would have seemed extreme. Today it registers as unlikely, but within the realm of discussion. The American government already controls more than 200,000 Bitcoin, largely obtained through legal forfeitures. Legislation proposing a strategic national Bitcoin reserve has been introduced by senators. Should the Treasury issue debt instruments explicitly supported by Bitcoin holdings rather than merely owning them? It would instantly elevate digital assets to reserve status in a manner private sector growth alone could never achieve. Consider this intriguing connection. Venezuela is reported to hold approximately 6,000 Bitcoin gathered through state mining and asset seizures. Recent diplomatic engagement between the United States and Venezuela has increased noticeably. Coincidence, perhaps? Yet when viewing competition between reserve currencies as a contest waged through financial tools rather than traditional military means, seemingly separate events begin to align. Motivations often provide the clearest explanation for actions. Follow the incentives consistently. Imagine the perspective of a leader like Xi Jinping. Over 15 years and roughly $1 trillion, China has advanced the Belt and Road program, extending credit to numerous nations to secure strategic influence and expand use of the yuan. Progress toward building alternative systems is underway. Then suppose the United States issues a brief announcement stating the dollar now carries backing from a Bitcoin reserve. Would the response be confrontation, Freudian, dumping trillions in treasury holdings to disrupt American markets and risk open financial conflict? Or measured cooperation, accepting continued American influence while diminishing the relative power of gold holdings and past lending efforts? The choice resembles joining a poker table, building a strong position over hours, only to learn mid-game that the rules have switched to chess. You could fold and lose accumulated gains, or continue playing under altered conditions set by others. Similar strategic calculations are likely occurring in major capitals today. This brings us back to Marcus. Recall Marcus at 44 diligently contributing to his retirement account and feeling positive as balances rise. What Marcus likely overlooks is important. Most people never review the detailed fund documents. If he did, he would discover his target date allocation consists of roughly 67% American stocks and 23% American bonds, with bonds scheduled to grow automatically closer to retirement. His entire savings essentially represent a sizable wager that American currency strength and manageable borrowing costs will continue for the next 2 decades or longer. This is not true broad diversification. It amounts to one large concentrated position on continued American monetary stability packaged to appear balanced. The uncomfortable aspect is that the wager might succeed. No one possesses certainty. Yet recognizing the nature of the bet is essential for making it deliberately. Marcus is placing a major macro-level stake without realizing any bet is involved. The real issue lies in that lack of awareness. Financial service providers also have built-in reasons to discourage close examination. Target date funds thrive on steady automatic contributions and minimal investor interference. Fees are collected steadily regardless of broader conditions. Explaining embedded risks does not align with their business model. This reflects incentives once more, not deliberate harm. Incentives shape behavior powerfully. One scenario that receives too little attention sits between extreme collapse forecasts and standard optimistic guidance. The probable path forward is not a sudden dollar failure. It is a transition toward a system with multiple competing reserve currencies. Similar to how global finance moved from British pound dominance in the late 1800s to dollar leadership after World War II. Not through one dramatic event but through gradual evolution spanning decades, we may be heading toward a landscape where the dollar, euro, yuan, International Monetary Fund drawing rights and certain commodity-linked digital forms coexist with varying importance across regions. In such an environment, the dollar would not vanish. It would lose influence slowly, perhaps 5% in one period, 3% in another, across many years. The erosion feels minor until you measure retirement resources against actual goods and services. By then, important compounding opportunities have been missed permanently. A revealing comparison involves the S&P 500 performance measured not in paper dollars but against gold ounces between 2001 and 2025. Over that span, the index appears essentially unchanged in gold terms. Despite showing large nominal gains when viewed only in dollars, gold rose at a pace roughly matching broad equities, meaning much of the apparent stock market growth was offset by monetary expansion in real terms. Marcus believes he is advancing. In reality, he maintains position. The account balance suggests success. That disconnect between reported numbers and true economic value creates the greatest vulnerability when underlying rules evolve. My experience over more than 10 years building businesses alongside accounting and legal professionals has taught one consistent truth. Success comes less from raw intelligence than from clearly identifying the game being played, and especially from recognizing early when the rules begin changing. Many investors continue operating under conditions that prevailed around 1985. Moderate inflation, reliable dollar-strength bonds providing safety, and stocks delivering positive returns over long horizons. That environment created substantial wealth for participants. Yet the supporting conditions now face serious challenges for the first time in a generation. Let me emphasize clearly that none of this calls for immediate panic selling or drastic liquidation. Emotional reactions usually worsen outcomes during gradual structural changes. Panic leads to selling low, buying high, and a series of decisions that seem reasonable individually but compound into major losses. A measured, thoughtful adjustment based on awareness of the real dynamics serves better. Here are 3 specific practical steps tailored to the present moment, not generic suggestions. First, run your retirement calculations using 5% average annual inflation rather than the usual 2.5% default. Observe how that single change affects projected future buying power. If the impact appears severe, address it while time remains. If the plan holds up well, you gain greater confidence moving forward. Second, review the average maturity length of bonds in your portfolio. For target date funds, this information appears in the fund documents or summary sheets. Maturities longer than 10 years introduce notable sensitivity to rate increases. A 30-year treasury might lose about 20% of market value for every 2 percentage point rise in yields. Shifting toward shorter-term bonds or treasury bills currently offering 4 to 5% with minimal rate risk reduces unneeded exposure. This is prudent risk management, not a negative market view. Third, consider adding modest positions in assets that do not move in lockstep with the dollar. This does not require abandoning stock index funds. It simply recognizes that concentrating all wealth in dollar-based holdings represents its own form of concentration risk. Reducing that concentration is standard practice, not excessive caution. Options include stocks from developed international markets. A reasonable gold allocation which rose nearly 29% in 2024. A small Bitcoin exposure based on the possibility even at 10% likelihood that it gains official reserve status, offering attractive upside potential. And productive real-world assets such as rental real estate, operating businesses, or personal skills that create value across different monetary regimes. Throughout history, those who navigated monetary shifts successfully focused less on hoarding the most precious metals or cash. They owned productive assets capable of generating real returns independent of any single currency system. This idea predates modern central banking. It will endure beyond current arrangements. Returning to Marcus for the final reflection. Marcus could ultimately fare well. He might reach retirement in 2047 with the dollar still prominent, moderate inflation, and his fund performing as expected. That remains possible. Yet his approach involves an implicit large-scale wager on one particular economic path without full awareness. Data and historical patterns indicate a meaningful chance that path may not unfold as assumed. Recognizing the wager you are making represents fundamental financial awareness, not negative thinking. Many lack this awareness because the industry structure benefits from limited scrutiny. Detailed reports from institutions like the Bank for International Settlements describe the stresses in measured language. I review that material regularly. My role is to distill what truly counts from those dense documents. The long-standing global agreement is now open for discussion, not necessarily ending but subject to revision. The original terms accepted for 80 years due to lack of alternatives now face challenge from nations possessing sufficient scale to consider walking away. Whether the outcome is renewed dollar-centered terms, a new parallel system, or a complex mixed arrangement, awareness that active negotiation is underway forms the basis for sound decisions in the years ahead. Slow developing pressures often damage most severely not those who remained unaware, but those who noticed the signals, postponed action, and never followed through. That pattern is not optimism. It is a costly form of avoidance that compounds over time. Avoidance at compounding rates destroys wealth more reliably than almost any other behavior I have observed. Steady, consistent investing created more lasting success than speculative trends. In the current year, however, steady investing requires awareness of the larger environment surrounding your portfolio, not overlooking it under the banner of passive management. The core habits remain valuable. Contribute regularly. Keep costs low. allow time and compounding to function. The surrounding context, however, has evolved. Grasping that new context is now essential. The original renters are exploring other locations. The property owner is modifying contract terms while the agreement remains active, and the neighboring property is beginning to appear increasingly attractive,